This moment has been destined for a long time. The signs were there for years, but the impact only now lands with brutal clarity. What seemed like a distant shock is unfolding as an inescapable consequence of choices made long ago. The picture isn't about some external crisis alone. It's about a self-inflicted wound, a bubble that has to release its air before it can heal. This is the point where the dream of infinite consumption clashes with the stubborn math of production and debt. First, the illusion of the cure. For a long time, the narrative was that the problem was outside, that imports and deficits were the cause and foreigners held all the leverage. The idea was seductive. If others could be blamed, then the prices of our lives could stay high, the stock market could keep climbing, and the next vacation, the next gadget, the next luxury would remain within reach. But the reality hides in plain sight. Deficits are symptoms, not the root disease. The core issue rests here, in the United States, in how choices were made about production, savings, and investment over decades. Nobody is cheating us. The system was designed to rely on perpetual external finance to sustain a lifestyle that outpaced real, domestic capability. How did this happen? By living beyond means and then turning to debt as a loophole. The country sold assets, outsourced factories, and borrowed from abroad to finance a standard of living that our own output could not sustain. Foreigners did not force this. They simply provided the channel through which it was financed. They built the things we did not produce, bought the assets we sold, and lent the money that kept demand alive in the short term. What Americans experienced was a routine hustle, more goods at lower prices, aided by low interest rates and a booming stock market that rewarded paper wealth even if the underlying economy lagged. So what did Trump tap into when he pressed the idea that deficits were the decisive problem? He pointed to a shortcut, blamed the imbalance on foreign players, and in his view, forced a recalibration. The trap, however, lies in misunderstanding the mechanism. If the policy goal becomes simply to reduce deficits without repairing the underlying productivity and competitiveness, the energy released by that recalibration could destabilize the entire system. The global liquidity machine, built on a web of currencies, reserves, and cross-border capital flows, depends on a degree of smooth functioning that cannot be guaranteed by blaming others or by waiving tariffs as a panacea. What happens next if the leverage and the money flows that buoy this system begin to retreat? The answer is a cascade. Interest rates would rise as domestic saving would have to replace foreign funding. Prices for consumption could rise as the cost of imports increases due to reduced foreign demand and higher wages needed to attract domestic production. The stock market, long driven by easy money and the perception of perpetual growth, would adjust downward to reflect more realistic profits and a reallocation of capital. In such a scenario, many Americans would feel the sting in their everyday life. The myth of wealth created by debt and financialized assets would confront the reality of shrinking purchasing power and tighter financial conditions. Yet, within this painful transition lies a hard, practical truth. Liberation from illusion requires a return to fundamentals. The path forward is not a scream for debt expansion or a desperate chase for one more round of stimulus. It's a sober plan to rebuild productive capacity, core industries, supply chains, and investments in technology and infrastructure that can make the country competitive again. It means learning to live within means, prioritizing savings, and turning to domestic production to anchor a more resilient economy. The road is difficult and the short-term pain is real, but the long-term reward is a system that isn't dependent on constant overseas financing to sustain a high standard of living. In the near term, what matters most is the alignment of expectations with reality. Inflation isn't a temporary blip, it's a signal of deeper disequilibria, and the longer the gap between policy rhetoric and economic reality persists, the more acute the corrections will be. The Fed's role, whether seen as independent or politicized, will be tested by the magnitude of the adjustment. Markets will respond to shifts in rates, credit conditions, and the health of the real economy. The challenge is to prepare for those transitions in a way that preserves social and financial stability while laying the groundwork for durable growth. Why gold? Because it is the most tangible reflection of value when confidence in the dollar and in the fiat system wavers. The metal has a long history of preserving wealth when paper claims lose credibility. This is not a call to abandon all financial instruments or retreat into dust-covered vaults. It's a call to recognize that the monetary system is a social contract that can fracture under pressure. Diversification across hard assets, productive enterprises, and prudent financial instruments becomes not just prudent but essential as part of a broader strategy to weather the coming realignments. Finally, the question facing every investor, policymaker, and citizen is simple in form, hard in practice. What is the sustainable path forward? It is not the dramatic one-off fix, but a steady, deliberate recalibration. It requires discipline in spending, a renewed focus on manufacturing and export-oriented growth, and a willingness to tolerate a phase of reduced consumer exuberance in exchange for long-term stability. If the nation can embrace this recalibration, the future can still hold opportunity, though the shape of prosperity will be different from the past. If not, the pain will intensify, and the consequences will be borne more heavily by those who trusted in a perpetual debt-fueled expansion. This leads directly to the question of what replaces the dollar when confidence erodes. The answer has been forming quietly, outside the headlines, as central banks around the world have been repositioning their reserves. Gold has surged over $250 in just 3 days, an acceleration that reflects not speculation but calculated repositioning by institutions that understand what's coming. Over the past year, gold climbed from $2,000 to $3,000 per ounce, yet most private investors missed it entirely. They were distracted by Bitcoin, by talk of digital gold, by the promise of quick returns in a new asset class. Meanwhile, central banks were methodically buying physical gold, preparing for a world where the dollar no longer anchors the global monetary system. Why gold and why now? Because when a reserve currency loses its credibility, there must be something tangible to replace it. Gold was the original reserve before the dollar took over after Bretton Woods. The deal was simple. Countries would hold dollars instead of gold because the dollar was backed by gold and could be redeemed for it at any time. It seemed like the best of both worlds: liquidity, convenience, and the security of gold backing. But that promise was broken in 1971 when the US suspended gold convertibility. The world has operated on a fiat system ever since, built on trust and the perception that the dollar would always be accepted. That trust is now fracturing under the weight of debt, deficits, and policy decisions that prioritize short-term political gains over long-term stability. Central banks understand this dynamic intimately. They have been steadily increasing their gold reserves, not as a hedge against market volatility, but as a foundational shift in how they structure their reserves. China, in particular, has been actively diversifying away from the dollar. Recent moves suggest they are not only buying gold, but also accumulating euros. The logic is clear. If the US is no longer the reliable consumer market it once was, then Europe becomes the next natural partner. The euro has climbed to 3-year highs, making European consumers wealthier in relative terms. China can redirect exports that once went to America toward Europe, and the Europeans, now richer, can afford more. This is not a crisis for China, it's an opportunity to rebalance trade flows and reduce dependence on a single, increasingly unreliable market. The ripple effects extend across continents. South American countries, which once exported raw materials and agricultural products to the US, are now shifting those exports to China and other emerging markets. As these countries earn more from exports, their own purchasing power increases, allowing them to buy manufactured goods from China that would have previously gone to the US. The entire global trade network is reconfiguring around the reality that the US consumer is no longer the engine of global demand. This is not a global recession, it's a reallocation of prosperity. The wealth that was artificially concentrated in the US through debt and financial engineering is now dispersing to the countries that actually produce goods and generate surpluses. This transition is deflationary for the US, but inflationary for the rest of the world in a constructive sense. Countries with trade surpluses and growing reserves can invest in their own infrastructure, raise wages, and build domestic consumption. The overvalued dollar, which for so long suppressed their purchasing power, is now weakening, and that weakness translates into real gains for emerging markets. The burden that the US imposed on the global economy through its persistent deficits and reliance on foreign capital is lifting. The world is being liberated from the need to finance American consumption, and that liberation is a net positive for global growth. But what about gold stocks? Here is where the opportunity becomes especially compelling. Physical gold is being bought by central banks, but gold mining stocks have been largely ignored by private investors. This has created a historic valuation gap. Gold miners are trading at single-digit price-to-earnings multiples, even as the price of gold soars. The reason is simple. Central banks buy bullion, not equity, but private investors, pension funds, endowments, and hedge funds are starting to wake up to the opportunity. When they do, the flood of capital into gold mining stocks will be dramatic. These companies own gold that is still in the ground, and the cost to extract it has never been lower relative to the price of gold. Oil, the primary input cost for mining, is historically cheap compared to gold. The profit margins for these companies are about to explode. This is not just a play on gold prices rising, it's a play on a structural shift in how investors allocate capital. For over a decade, money that should have gone into gold and gold stocks flowed instead into Bitcoin, driven by hype, celebrity endorsements, and the promise of a new monetary paradigm. But Bitcoin, since its peak in late 2021, is down more than 30% relative to gold. Despite ETFs, despite political support, despite the narrative of a strategic reserve, Bitcoin has underperformed the one asset it was supposed to replace. The market is beginning to recognize this, and when the reallocation happens, gold stocks will be the primary beneficiaries. The world is not moving toward a single reserve currency, it's moving toward a multi-reserve system anchored by gold. Countries will hold a mix of currencies, dollars, euros, yuan, but the foundation will be gold because it is the only asset that carries no counterparty risks. It cannot be printed, devalued by policy, or seized through sanctions. This is why countries are not only buying gold, but also repatriating it, bringing it back within their own borders to ensure full control. Trusting another country to hold your gold is a risk that fewer nations are willing to take, especially as geopolitical tensions rise and the use of financial sanctions becomes more common. The implications for the US are profound. The country has been running multi-trillion-dollar deficits financed by foreign buyers of treasury bonds. As those buyers shift to gold and other assets, the demand for treasuries will fall, forcing yields higher. Higher yields mean higher borrowing costs for the government, which in turn means even larger deficits unless spending is cut dramatically. The Fed will face a choice: allow rates to rise and risk a financial crisis, or intervene with rate cuts and quantitative easing, which will fuel inflation. Either path leads to pain, but the inflationary path is more likely because it allows the government to nominally service its debts even as the real value of those debts is eroded by currency depreciation. This is the crossroads. The global monetary system is being rebuilt, not through some grand international conference, but through the quiet, deliberate actions of central banks and market participants. Gold is at the center of this rebuilding, and the investors who recognize this early will be positioned to benefit as the transition accelerates. The next part will examine the policy responses, the risks to the financial system, and the choices that will determine whether this transition leads to a painful but necessary correction or a chaotic collapse. The Federal Reserve now faces a dilemma that has no clean solution. Inflation expectations have surged to 6.7%, yet the Fed continues to insist that long-term expectations remain anchored at 2%. This claim is increasingly detached from reality. The anchor has slipped, and pretending otherwise only deepens the credibility gap. The Fed has spent years communicating a narrative of control, of precision, of data-driven policy, but the data now points to stagflation, a scenario the Fed has no plan to address. About a year ago, when asked about the risk of stagflation, Powell dismissed the concern outright. He said he saw no evidence of either stagnation or inflation that would justify worry. That statement will be remembered alongside other famous miscalculations. Subprime is contained, inflation is transitory. The pattern is clear. Central banks consistently underestimate the severity of problems until those problems become unavoidable. The issue is not just forecasting error, it's structural blindness. The Fed's models, its stress tests, its entire framework assumes that crises follow predictable patterns. But stagflation does not fit those patterns, and the system is not prepared. Consider the stress tests that banks undergo annually. These tests simulate adverse scenarios to ensure that banks can withstand shocks. Yet every scenario assumes that in a downturn, interest rates will fall. The possibility of a recession combined with rising rates has never been tested, likely because the results would be catastrophic. Banks are leveraged to an environment of low rates and steady growth. If rates rise while the economy contracts, loan defaults would surge, asset values would collapse, and the solvency of the entire financial system would be in question. The Fed knows this, which is why it has avoided even modeling such a scenario. But avoiding the question does not make it go away. The immediate risk is that the Fed will wait too long to act, hoping that inflation will moderate on its own or that the economy will stabilize without intervention. This waiting game is dangerous because once confidence erodes, it erodes quickly. Markets move faster than policymakers, and by the time the Fed recognizes the need for action, the options will be limited and the costs will be higher. The likely response will be a return to rate cuts and quantitative easing, flooding the system with liquidity to prevent a financial collapse. But this response will accelerate inflation, pushing it well beyond current levels and triggering a further decline in the dollar. This is the paradox. The tools the Fed has used for decades to stabilize the economy will now destabilize it. Lower rates and QE worked in a deflationary environment where the primary risk was falling demand. But in an inflationary environment, those same tools pour fuel on the fire. The result will be higher consumer prices, higher long-term interest rates as bond markets demand a premium for inflation risk, and a weaker dollar as foreign investors pull capital out of dollar-denominated assets. The Fed will find itself trapped, unable to raise rates without collapsing the economy and unable to lower rates without destroying the currency. What does this mean for the real economy? Widespread layoffs are coming. The service sector, which has been the engine of employment growth for years, is heavily dependent on consumer spending. As imports become more expensive due to tariffs and a weaker dollar, the availability of goods will decline. Businesses that rely on those goods will face shortages, higher costs, and shrinking margins. Many will close. The unemployment rate, which has been artificially suppressed by low-quality jobs and government spending, will rise sharply. The social and political consequences of mass unemployment in an inflationary environment are severe and unpredictable. Yet this crisis is not global. It is distinctly American. The rest of the world, freed from the need to support the US economy, will experience a period of relative prosperity. Emerging markets, in particular, stand to gain. They have been held back for years by an overvalued dollar that made their exports less competitive and their debts more burdensome. As the dollar weakens, those debts become easier to service and their export sectors become more competitive. Capital that once flowed to the US will now flow to markets with stronger fundamentals and better growth prospects. This is a rebalancing painful for the US but constructive for the global economy. The question is whether the US can use this crisis as an opportunity for genuine reform. The path forward requires austerity, not in the sense of punishing ordinary citizens, but in the sense of living within means. It requires rebuilding industrial capacity, investing in infrastructure, and prioritizing savings over consumption. It requires a shift in mindset from short-term gratification to long-term resilience. These changes are possible, but they require political will and a willingness to accept short-term pain for long-term gain. The current trajectory suggests that such will is lacking, which means the pain will be prolonged and the recovery delayed. The final part will explore what comes next and what investors can do to protect themselves in this environment. The endgame is now in motion, and the choices made in the next months will determine whether this crisis becomes a catalyst for renewal or a descent into prolonged decline. redefine. The financial system is built on confidence, and confidence is evaporating. For decades, the world believed in the dollar's stability, in the strength of American institutions, in the idea that growth could be sustained indefinitely through debt and financial engineering. That belief is breaking down, and with it, the structures that depended on it. Gold will continue to rise, not because it is becoming more valuable, but because the dollar is becoming less so. When the US was founded in 1789, $20 bought an ounce of gold. Over a century later, when the Federal Reserve was established in 1913, $20 still bought an ounce of gold. The dollar held its value because it was tied to something real. That stability lasted until 1933, when Roosevelt devalued the dollar to $35 per ounce. Even then, that price held until 1971, when Nixon severed the link to gold entirely. Since then, the dollar has lost more than 99% of its purchasing power. Gold has risen from $35 to over $3,000, not because gold changed, but because the dollar did. This history matters because it shows what happens when money is decoupled from discipline. A fiat system managed responsibly can work, but when governments face the choice between hard decisions and printing money, they almost always choose the printing press. The result is inflation, the silent erosion of wealth, and the eventual collapse of confidence. We are at that point now. The predictions of $5,000 gold that seemed extreme a decade ago are now conservative. Given the explosion of debt and money supply since then, $20,000 gold or higher is not only possible but likely. The question is not if, but when. For investors, the opportunity lies in gold mining stocks. These companies are positioned at the intersection of rising gold prices and falling input costs. They own reserves in the ground that are valued far below the current and future price of gold. As the gap between physical gold prices and mining stock valuations closes, the returns will be extraordinary. A 5-fold or even 10-fold increase is realistic if gold reaches $4,000 or beyond this year. The risk is minimal compared to the potential reward, especially for those who understand the structural forces driving this shift. Bitcoin, despite the hype, has proven to be a distraction. It has underperformed gold significantly since its peak, and the narrative that it could serve as a reserve asset has been exposed as wishful thinking. Central banks are not buying Bitcoin, they are buying gold. The talk of a strategic Bitcoin reserve was always more about political theater than sound monetary policy, and recent events have likely put an end to that fantasy. The capital that flowed into Bitcoin and related ventures will eventually find its way back to real assets, and gold will be the primary beneficiary. The world does not need a single reserve currency. What it needs is sound money, and gold has always been the ultimate form of sound money. Countries are moving back to a gold-backed system, not through formal agreement but through individual action. They are buying gold, repatriating it, and using it as the foundation for a more stable and diversified reserve structure. This is not a return to the past, it is an evolution toward a more resilient future. The US can either participate in this evolution by restoring fiscal discipline and rebuilding productive capacity, or it can resist and suffer the consequences. The pain ahead is unavoidable, but it can be constructive if handled correctly. Austerity, in the true sense, means cutting wasteful spending, eliminating subsidies that distort markets, and allowing resources to flow to their most productive uses. It means rebuilding supply chains, investing in education and infrastructure, and fostering innovation. It means accepting that the easy money era is over and that prosperity must be earned through productivity, not borrowed through deficits. This is hard work, and it requires sacrifices, but the reward is a more sustainable and equitable economy. The alternative is far worse. If policy continues down the current path, more spending, more printing, more denial, the result will be hyperinflation, social unrest, and the loss of global standing that could take generations to recover from. The window for corrective action is closing. The longer the delay, the more severe the adjustment will be. For those prepared, this environment offers rare opportunities. Gold and gold stocks are the clearest plays, but there are also opportunities in emerging markets, in hard assets, and in businesses that produce real value rather than financial paper. The key is to think in terms of fundamentals, not narratives. The narratives that dominated the last decade, endless growth, tech disruption, digital currencies, are giving way to a harsher reality where tangible value and productive capacity matter most. This is not the end of the world, it is the end of an illusion. The bubble has burst and the air is rushing out. What comes next depends on the choices made now. Will there be a return to discipline, to savings, to investment in the real economy? Or will there be more denial, more printing, and a slide into chaos? The answer is not yet written, but the signs are clear. The time to act is now, before the window closes and the options narrow further. Those who recognize this moment for what it is will be positioned not just to survive, but to thrive in the world that emerges from the wreckage of the old order.